Before we look at the economic calendar though, I think it's important to understand why slippage occurs. You know, why is it that your broker keeps slipping you and you keep getting stopped out at the price you didn't want? Are they playing silly buggers? Are they messing you around? Are they stealing money out of your trading account? Well, it's important to understand what's happening. This is called the market depth for a market. You may be familiar with the term superdome or level 2. It's really a way of looking at, or depth of market, it's really a way of looking at the contracts that are being bid and offered at particular prices. So what you have here is a sort of a ladder of prices. This is for the S&P 500 index, the biggest, most liquid index contract in the world. It's back in 2011, doesn't really matter when it was, it's just a simple chart, a simple demonstration really. And what you have here is a ladder of prices. Now what you're seeing here is 13.35 and 3/4 to 13.36. So in other words, if you're looking at your spread betting platform, you'd be looking at a price of something like 335.7 to 1336.1, something like that. Okay, so you'd be looking at a spread of say 0.4 around that market price. Okay. Now what you've got on the chart here, on the left is orders to buy. Now it's only quoted at 13.35 and 3/4 because somebody is prepared to buy at that price. Now this is the actual market, not what your spread betting company's quoting. This is the actual market on the actual exchange, on the Chicago Mercantile Exchange for this market. So what you've got here is 62 contracts wanting to buy the S&P 500 at 13.35 and 3/4. Now what somebody could do is buy at market straight away at the market price and pay 13.36 if they wanted to. And they would start buying from the 406 contracts waiting to sell there. So all of these contracts here are contracts waiting to buy at these different prices. So down here at 13.34, I've got somebody, or lots of different institutions or whatever, wanting to buy 129 contracts there. Think of it like shares in your stockbrokers or a particular stock. So, and this is ever flowing, ever changing, and people are adding orders in, deleting orders out, and so on. So in other words, you can see the depth of the market. So for any price, you can see the number of contracts working to buy at each of those levels. Equally, the orders working to sell at those levels. So for example, at 13.38, I've got 543 contracts waiting to sell at that level. So these are making the market. Now, of course, what happens is, over economic data, then not only is it us that gets a little bit nervy, a little bit apprehensive over data, but so do the bigger institutions. Why? Because it represents risk. So what you generally find is that a lot of the bigger traders will start deleting their orders because they don't want to have an order in the market at such uncertain times. So they'll rather sit back and see what the data is, what the news item is, what GDP is, what interest rate decisions turn out to be, and then make decisions after that. So what these big institutions do, and what we should certainly do, is they delete their orders. So all of this market depth ends up being completely different at market data. You end up becoming much less liquid, much less liquidity behind each of these orders as these orders are cancelled. Now with my limited experience of, editing images, I've just played around with this just to say, look, suddenly you're getting lots of gaps in the order book here. You see all these holes here? Now there's 0 contracts at these various prices. Remember before we had quite a few contracts there? Now there's none. So what you've got is lots of gaps in the order book there. So from 13.36 1/4 jumping to 13.37 1/4. You see that market in spread betting terms is 10 points. It could move 10 points there from there to there without hardly anything being traded at all. And this is why over major economic data the markets move incredibly fast. It's not to say that a lot of trading is actually being done. It may perhaps be, but it's not necessarily the case. It could be that over that particular short period the markets become incredibly erratic, incredibly volatile because of the very thin order book there. orders being deleted, orders being cancelled. So when trading is done, when activity is done in the market has to move very, very fast to catch up with the orders that are being placed because of the lack of depth of market. Because if somebody wanted to buy, say, if we were trading at 13.36 and a quarter offered, if someone wanted to buy 150 contracts, it would jump from 13.36 and a quarter straight up to 13.37 and a quarter, and then straight up further, and it moves very fast, jumpy, very fast markets. And that's what happens over thinner markets, thinner order books, very jumpy, very gappy markets. Now, that's what happened over the slippage. It's not to say the market traded massive volume, although it probably did trade a lot. The point is, the order books really thin out. That then leads to fast moving markets, which leads to risk, which leads to potential risk of slippage. So you can end up getting out at a lot worse price than you may have originally wanted. Now, this may seem very daunting for a lot of traders. You may be thinking, oh my God. Well, of course, we know when this data is going to happen, don't we? We know when it's likely to happen. We know when it's going to be announced. And they are bang on time with this data. Very rarely is it early or late. Usually it's bang on. So check your economic calendars. Work out what data is coming out. Where are those banana skins lurking? And then adjust your trading accordingly. You may decide that it's UK interest rates today, so I'm not going to trade FTSE all day. I'm not going to trade sterling dollar all day either, because it's just going to be a bit weird, a bit jumpy. Plan your day accordingly. Look at the news and announcements.